The story of Lehman Brothers did not begin with greed or excess. It began with ambition, resilience, and the American immigrant dream. In 1844, a young German immigrant named Henry Lehman arrived in Alabama with little more than determination and a belief in opportunity. He opened a small dry goods store, selling cotton supplies to local farmers. What began as a modest family business soon evolved into something far greater when Henry's brothers, Emmanuel and Meyer, joined him. Together, they realized that cotton itself, rather than the tools sold to farmers, was the real source of power and profit. By acting as intermediaries between Southern cotton producers and global markets, the Lehman Brothers positioned themselves at the heart of America's most important commodity trade. After the Civil War, Lehman Brothers made a strategic shift that would define its future. The firm moved from the South to New York City, aligning itself with the rising power of finance rather than agriculture. This move transformed Lehman Brothers into an investment bank, financing railroads, manufacturing companies, retailers, and eventually some of the most iconic corporations in American history. Over decades, Lehman earned a reputation for prudence, intelligence, and adaptability. It survived the Great Depression, 2 world wars, and countless market downturns, reinforcing its image as an institution built to last. By the late 20th century, Lehman Brothers had become a symbol of Wall Street prestige. Its offices reflected power, its executives commanded respect, and its deals shaped global markets. Unlike newer investment banks, driven purely by short-term gains, Lehman carried a sense of tradition and internal belief that it was different, smarter, and more disciplined than its competitors. This confidence, once a strength, would later become a dangerous weakness. As financial markets grew more complex and risk-taking became normalized, Lehman slowly drifted away from its conservative roots. The rise of Lehman Brothers was not fueled by recklessness, but by adaptation. Yet adaptation without restraint can quietly turn into overconfidence. As financial innovation accelerated and profits soared, the firm began embracing risks it did not fully understand, convinced that its history guaranteed its future. The foundation of a century-old institution appeared solid, but beneath the surface, cracks were forming, cracks that would eventually bring down one of the most powerful banks in the world. By the late 1980s and early 1990s, Wall Street was undergoing a fundamental transformation. The traditional model of investment banking centered on advisory services, underwriting, and long-term relationships was being replaced by a new culture driven by trading profits, financial engineering, and aggressive risk-taking. Deregulation, technological advancement, and globalization reshaped the financial landscape, allowing banks to operate faster, larger, and with far greater leverage than ever before. Lehman Brothers, like its competitors, found itself pulled into this new reality, where caution often meant losing ground to more aggressive rivals. The introduction of complex financial instruments promised efficiency and profitability, but quietly increased systemic risk. Derivatives, mortgage-backed securities, and structured products allowed banks to transform illiquid assets into tradable instruments, generating enormous short-term gains. These products were marketed as sophisticated tools that spread risk across the system, but in reality, they often concentrated risk in ways that were poorly understood. Lehman's traders and executives embraced these innovations, convinced that advanced models and historical data could manage any potential downside. Risk, once something to be minimized, became something to be optimized. As profits surged, so did incentives. Traders who generated profits were celebrated, while those who raised concerns were often ignored or sidelined. This shift in culture gradually eroded internal discipline. Decisions that would once have required careful scrutiny became routine, justified by market trends and competitive pressure. Lehman was no longer just participating in the market, it was racing to keep up with it. This transformation was not unique to Lehman Brothers. It reflected a broader change in the financial system, where success was increasingly measured by quarterly earnings rather than long-term stability. Risk became abstract, buried within models and spreadsheets, disconnected from real-world consequences. Lehman's leadership believed that the firm was navigating this environment intelligently, balancing innovation with control. Yet as leverage increased and exposure deepened, the margin for error shrank. The culture of risk that took hold on Wall Street laid the groundwork for Lehman's eventual collapse. It normalized behavior that would once have been considered reckless and encouraged blind faith in financial complexity. The firm's long history created an illusion of invulnerability, masking the dangers accumulating beneath the surface. What appeared to be progress was, in reality, a slow march toward instability. At the heart of Lehman Brothers' downfall lay a single massive conviction that the American housing market would continue to rise. During the early 2000s, home prices across the United States surged at unprecedented rates. Low interest rates, easy credit, and widespread belief in ever-increasing property values created an environment where housing seemed like a risk-free investment. For Wall Street, this boom represented an opportunity too large to ignore. Lehman Brothers did not merely participate in this market, it embraced it with extraordinary enthusiasm. Lehman aggressively expanded its real estate operations, becoming one of the largest underwriters and traders of mortgage-backed securities. These complex products bundled thousands of home loans together and sold them to investors worldwide. The logic was seductive. Diversification would reduce risk, and rising home prices would protect against defaults. Even subprime mortgages loans given to borrowers with weak credit were repackaged and sold as safe investments, shielded by financial engineering and optimistic assumptions. Lehman's balance sheet swelled as profits poured in, reinforcing confidence in the strategy. What made Lehman's approach especially dangerous was its decision to hold large amounts of these assets on its own books. Unlike some competitors that sold mortgages quickly, Lehman increasingly retained exposure, betting on long-term appreciation. This strategy magnified profits during the boom, but left the firm dangerously vulnerable when conditions changed. Executives relied heavily on risk models that assumed housing declines would be localized and temporary, ignoring the possibility of a nationwide collapse. History offered no clear precedent for such a scenario, and this absence of precedent was mistaken for impossibility. As warning signs began to emerge, rising default rates, slowing home sales, and growing borrower stress, Lehman largely dismissed them. Internally, concerns were raised, but they were often overshadowed by the sheer scale of profits generated by real estate trading. The belief that markets could be managed, hedged, or exited in time proved dangerously optimistic. The firm had placed an enormous bet on a single sector, tying its fate to the continued strength of housing. When the housing market began to falter, Lehman's exposure became a trap. Assets once considered liquid grew difficult to sell, and prices fell faster than models predicted. The same leverage that had amplified gains now magnified losses. Lehman had not merely invested in housing, it had woven real estate into the very fabric of its balance sheet. As the foundation cracked, the entire structure of the firm began to tremble. In modern finance, survival depends not only on solvency, but on confidence. Lehman Brothers learned this lesson in the most brutal way possible. As 2007 turned into 2008, the firm faced a growing liquidity crisis, not because it had officially run out of assets, but because the market no longer trusted their value. Lehman relied heavily on short-term borrowing to fund long-term investments, a common practice on Wall Street. As long as lenders believed in Lehman's stability, this system functioned smoothly. The moment doubt entered the equation, it became a death trap. Counterparties began demanding higher collateral, refusing to roll over loans, and quietly reducing exposure to Lehman. What once felt like routine market behavior suddenly became hostile. Every trading day turned into a test of survival, with billions of dollars flowing in and out of the firm to maintain operations. Lehman executives insisted the firm was well capitalized, but markets no longer believed official statements. Confidence, once lost, could not be restored by words alone. Inside Lehman, panic spread through executive meetings and trading floors. Emergency plans were drawn up, including asset sales, spin-offs, and capital injections. Yet each attempt to stabilize the firm produced unintended consequences. Selling assets depressed prices further, confirming market fears. Seeking outside investment raised questions about solvency. Even routine financial disclosures were scrutinized for signs of weakness. The firm found itself trapped in a vicious cycle where efforts to survive accelerated its collapse. The role of leverage intensified the crisis. Small declines in asset values produced massive impacts on Lehman's balance sheet. Losses that appeared manageable on paper became catastrophic when translated into liquidity demands. Risk models, built on assumptions of orderly markets, failed completely in an environment dominated by fear. Lehman was not just fighting financial losses, it was fighting psychology. Perhaps the most devastating aspect of the liquidity trap was its speed. Decades of reputation and trust unraveled in months, then weeks, then days. Clients quietly withdrew funds. Partners prepared contingency plans, and competitors positioned themselves for Lehman's failure. What had once been unthinkable became increasingly inevitable. The market was no longer asking whether Lehman would survive, but how long it could last. By mid-2008, Lehman Brothers was no longer steering its destiny. It was reacting hour by hour to a crisis fueled by lost confidence. In modern financial systems, perception can become reality. And for Lehman, perception had already delivered a verdict. As Lehman Brothers' position deteriorated, attention shifted from denial to desperation. By the summer of 2008, it was clear that the firm could not survive on confidence alone. Executives, regulators, and rival banks all understood that Lehman needed a rescuer, or it would collapse. What followed was a frantic series of negotiations, conducted behind closed doors, where billions of dollars, political pressure, and fear of systemic collapse collided. Lehman's leadership, led by CEO Richard Fuld, began searching aggressively for a buyer. The firm explored every possible option, including selling parts of its business or spinning off toxic real estate assets into a separate entity. These plans were designed to make Lehman appear more attractive, but time was running out. Potential buyers were wary of the firm's balance sheet, which was loaded with assets whose true value was increasingly uncertain. No one wanted to inherit losses that could sink their own institution. Government officials closely monitored the situation, but remained hesitant to intervene directly. Earlier in 2008, the Federal Reserve had helped facilitate the rescue of Bear Stearns, setting a precedent that markets assumed would apply again. However, political pressure was mounting. Critics argued that constant bailouts encouraged reckless behavior and moral hazard. Regulators now faced an impossible dilemma: rescue Lehman and reinforce the idea that Wall Street would always be saved, or let it fail and risk triggering a global financial meltdown. In September 2008, the crisis reached its peak. Lehman entered intense negotiations with potential buyers, including Bank of America and Barclays. Meetings stretched through nights and weekends as executives and regulators scrambled to structure a deal. Bank of America ultimately walked away, choosing to acquire Merrill Lynch instead, a move that stunned Lehman's leadership. Barclays showed interest, but regulatory hurdles and the lack of government guarantees made the deal impossible. Without official backing, no institution was willing to assume Lehman's risks. Inside these negotiations, the tension was extraordinary. Decisions that would reshape the global financial system were being made in real time, under immense pressure with incomplete information. Lehman executives believed the government would step in at the last moment, just as it had before. That assumption proved fatal. When it became clear that no bailout was coming, the final options evaporated almost instantly. The failure of these rescue attempts marked a turning point. Lehman Brothers was no longer a troubled bank seeking survival. It was a symbol of systemic failure. The collapse was no longer hypothetical. It was imminent. The only remaining question was how devastating the consequences would be once the firm finally fell. The final hours of Lehman Brothers unfolded in an atmosphere of exhaustion, disbelief, and quiet panic. Throughout the weekend of September 13th to 14th, 2008, executives, regulators, and bankers crowded into conference rooms, clinging to the hope that a last-minute solution might still emerge. Phones rang endlessly. Documents were revised, discarded, and rewritten. Yet with each passing hour, the reality became unavoidable. Lehman Brothers was running out of time. Late Sunday night, the firm's leadership confronted the truth they had resisted for months. There would be no buyer. There would be no government backstop. When markets opened on Monday morning, Lehman would not survive. In the early hours of September 15th, Lehman Brothers Holdings, Inc. filed for bankruptcy protection, marking the largest bankruptcy in U.S. history. A 158-year-old institution collapsed in silence, without ceremony, leaving behind shockwaves that would ripple across the world. Inside Lehman's offices, the mood was surreal. Employees arrived to find security personnel, confused instructions, and a sense of disbelief hanging in the air. Traders stared at screens that no longer mattered. Careers built over decades ended overnight. Many learned of the bankruptcy through news alerts rather than internal communication. For thousands of employees, the collapse was not an abstract financial event. It was personal, immediate, and devastating. As news of Lehman's failure spread, global markets reacted with fear bordering on chaos. Stock markets plunged. Credit markets froze. Banks stopped trusting one another, hoarding cash instead of lending it. The collapse shattered the illusion that some institutions were too big to fail. If Lehman could fall, any bank could. Confidence, the invisible glue holding the financial system together, began to disintegrate. Perhaps the most haunting aspect of Lehman's final night was its quietness. There was no dramatic crash, no final bell. The firm simply ceased to exist as a functioning institution. What remained were unanswered questions, abandoned desks, and a global financial system suddenly staring into the abyss. Lehman's death was not just the end of a company, it was the moment the financial crisis became undeniable. In the aftermath of Lehman Brothers' collapse, one question dominated public debate: who was responsible? The search for blame revealed a complex web of failures, where no single decision or individual could fully explain the disaster. Instead, Lehman's downfall emerged from a convergence of leadership misjudgments, regulatory shortcomings, and systemic flaws that encouraged excessive risk-taking across the financial system. At the center of scrutiny stood Lehman's leadership, particularly CEO Richard Fuld. Known for his aggressive style and unwavering belief in the firm's strength, Fuld resisted calls to scale back risk even as warning signs multiplied. Critics argued that his refusal to acknowledge reality delayed critical decisions, such as raising capital or reducing exposure to real estate. Supporters countered that Fuld was operating in an environment where retreat often signaled weakness and accelerated collapse. Regardless of intent, leadership choices played a decisive role in sealing Lehman's fate. Regulators also faced intense criticism. Oversight of investment banks had failed to keep pace with the complexity and scale of modern finance. Lehman operated with high leverage and limited capital buffers, exploiting gaps in regulatory frameworks that assumed markets could self-correct. Agencies relied heavily on credit rating firms and internal risk models, both of which underestimated the dangers of a housing downturn. When the crisis escalated, regulators lacked both the tools and the consensus to respond decisively. Beyond individuals and institutions lay a deeper issue: the structure of the financial system itself. Incentives rewarded short-term profits while diffusing long-term responsibility. Risks were spread across markets in ways that obscured accountability, allowing everyone to benefit during the boom and suffer collectively during the bust. Moral hazard encouraged the belief that failures would be absorbed by the system, reducing the perceived consequences of reckless behavior. Lehman's collapse shattered this assumption, but only after the damage was done. The question of blame ultimately revealed an uncomfortable truth. Lehman Brothers did not fail in isolation. It was a product of a system that normalized excessive risk, discouraged caution, and trusted complexity over judgment. The collapse forced policymakers and the public to confront the need for reform, not just of individual firms, but of the financial architecture that allowed such vulnerabilities to grow unchecked. The collapse of Lehman Brothers marked a permanent turning point in global financial history. It was not merely the failure of a single institution, but the exposure of deep structural weaknesses that had been building for decades. In the aftermath, policymakers, regulators, and markets were forced to confront uncomfortable realities about risk, accountability, and the limits of financial innovation. Lehman's downfall became a lesson written in losses, unemployment, and shattered trust. One of the most immediate consequences was the wave of reforms designed to prevent a similar collapse. Governments introduced stricter capital requirements, stress tests, and oversight mechanisms aimed at reducing excessive leverage. Financial institutions were subjected to greater scrutiny, and the concept of too big to fail was challenged through resolution frameworks meant to allow large banks to collapse without bringing down the system. While these reforms improved resilience, they also revealed the difficulty of balancing stability with innovation in a rapidly evolving financial landscape. For markets, the world after Lehman was defined by caution. Investors became more sensitive to risk, liquidity, and transparency. The assumption that governments would always step in to save failing institutions was shaken, reshaping behavior across financial sectors. Yet memories faded with time, and as markets recovered, familiar patterns of optimism and risk-taking re-emerged. Lehman's legacy served as a warning, but one that required constant reinforcement. Perhaps the most enduring lesson of Lehman Brothers is the power of confidence and its fragility. Financial systems are built not just on numbers, but on trust. Once that trust breaks, even the strongest institutions can fall with startling speed. Lehman's executives believed their history guaranteed survival. Regulators believed markets would self-correct, and investors believed complexity equaled safety. All three beliefs proved dangerously flawed. Today, Lehman Brothers exists not as a bank, but as a symbol. Its collapse reminds us that unchecked risk, blind faith in models, and delayed action can turn success into catastrophe. The behind-the-scenes story of Lehman is ultimately a human story of ambition, denial, pressure, and consequence. It stands as a permanent reminder that in finance, as in life, ignoring reality does not prevent collapse. It only makes it more destructive when it finally arrives.